Greetings and thank you for joining us at FutureMoneyTrends.com. I'm here at the Cambridge House for the Resource Investment Conference in Indian Wells with Mickey Fulp of themercenarygeologist.com. He has an opt-in newsletter you can subscribe to, as well as Brent Cook with ExplorationInsights.com. And I don't know, do you have a free newsletter? And I know you have the paid service. Do you also have a free one?
It's only paid, I'm afraid. I do have some free stuff I send out. There's a lot of information on my website, but it's a paid service for subscribers.
But these are both two men. They're both geologists. If you feel like you're looking for an edge when it comes to researching stocks, these are the two guys to talk to. So let's get started with the last week. It's been brutal for the mining stocks, as well as just anybody who's been even investing in bullion. We could even go back as a year or 2 years technically from the high. What are your guys' overall thoughts right now? What are you guys talking about as far as the mining stocks go?
I'll jump in. I just finished a presentation, so I know what I'm kind of what I'm going to say. It has been brutal for the mining companies, junior mining companies, exploration companies, for maybe 2 years. We did good last year, but that was an anomaly, I think. It's certainly gotten worse this year, the start of this year, and there's a few things that come into this, and Mickey will chime in when I'm right or wrong, I hope. But most of the people that got invested, big investors that got into the gold market and into the gold mining companies did so because they could see the rationale for the gold price going, and they got that right. It's gone from 250 to 1500. But the margins they expected their gold mining companies to continue making, they thought would expand, they didn't. Our costs have gone up almost in tandem with the gold price. So although we've seen a 20% annualized increase in the gold price, we've seen about an 8% annualized increase in profit margins. So that's been a real headache to the majors. And then you look at the junior mining companies, and it's tough to find something out there. Very, very tough to find a deposit, and it takes time and money. And a lot of the investors don't recognize that. They get the impression that it's easy and that they just buy this company who lays out their map and says, we got a deposit there, and it's not true. So those are the two things that really, I think, hurt the sector.
Well, let's talk about the sector a little bit. I mean, with most people who buy the mining stocks are actually first, they're concerned about inflation or government debt. But what about the actual fundamentals for the metals themselves? So let's say, like, there's probably 50 companies in here. I wish there was 100, so we use a round number. Let's say there was 100 companies. How many are actually going to actually discover something? I mean, what are the odds of a discovery?
Well, there's going to be a few going to discover something. How many of those will make mines? If there's 50 companies in there, 2 would be a good ratio, because most of them will have some sort of advanced project. Most of the companies that exhibit tend to be, I wouldn't say the cream of the crop, but they're really what I call the penny scrappers. Most of those companies wouldn't show up. I want to go back a little bit to the point that Brent was making, and the cost of production and capital expenditures have skyrocketed. So we've seen margins not increase. In fact, we've seen margins decrease. And a lot of that has to do with the price of oil. It's all about energy. And so it's one of these things, the cure for high prices is high prices, and vice versa. The gold price is very robust, but the energy inputs have increased. We've got $95 oil. We've been in a paradigm for the last couple of years with oil range bound between $85 and $110. That means that everything costs more all the time, and we've seen that reflected in the gold business, in the gold mining business. The other thing that's happened, especially with the majors, is they don't have enough gold. They are using up their reserves. The American brand of capitalism demands growth. And growth in earnings and growth in revenues. So what they've really tended to do is they've lowered the cutoff grades. So they're mining lower and lower grades, and they're reducing their profit margins. And there's, as alluded to, there's 2 reasons for that. Where do we come out of this? Well, what's going to happen is, if you're not in I was taught in 1982, and Brent and I discussed this earlier, when I first got at Santa Fe Mining with these little Apple computers we could run financial models on, and I was doing that at the time. And I was taught very early on by some really savvy people in the mining business that you need to be in the lowest quartile of peer production for any metal. So with with a lower gold price or margin decreasing, what we're going to see is production come off. Mines that are not profitable are going to shut down, and then we go back to the cure for low prices is low prices. Demand is still high, supply goes away, price got to go up.
In layman terms for everybody, how much does it cost to produce an ounce of gold?
Right now, overall cost worldwide, the number I saw most recently was $1,200 an ounce. I want to flip gears a little bit, and I just wrote a piece on platinum palladium. We just heard a talk on platinum palladium. The average price of platinum production all in worldwide is $1,600 an ounce. That's probably why I'm more bullish on platinum and palladium right now than I am on gold.
Yeah. With these miners, how long can it go like this where it's bad? Because if you look at like the mines themselves, they all have a life. So I mean, if they're barely turning over a profit at some point, so they're just going to close down, or these majors have to buy juniors, how long can we stay in this rut that the junior mining stocks and mining stocks in general are in?
Well, these bear markets historically have lasted 4 or 5 years. It's debatable how long we've been in this one. Brent just told us, and he's exactly right. The high, this cycle's high on the venture index was February 28, 2011. So it could be argued that was the beginning of the downturn of the Toronto Venture Index, which is what I use for a proxy.
So what are you guys doing? Are you guys buying right now on this dip?
You know, the title of my speech today was prerequisite to selling high is the question mark, is buying low. We're seeing some very low prices on some, very few actually, deposits that I think make good money. And this goes to what Mickey talked about. I look for someone who can produce gold or copper or whatever, at least in the bottom third of the industry. And you got to look at capex too. But that's what's going to survive, and that's what's going to be purchased by the major mining companies. I mean, consider we're burning through on a global basis 1 Carlin trend every year. We're producing enough gold, 80 million ounces, which is what's been produced from the Carlin trend over 30 years. We're not finding 80 million ounces a year. Same thing for copper. We're burning through 1 Bingham Canyon every year. We're not finding that. So, you know, regardless of what the companies do right now, which is they're going to cut back costs, they're going to start high grading, but that's not going to help their future. So there's a time coming when these high grade deposits or high margin deposits are going to be worth a lot. And that's what I'm starting to buy now. And I don't know where the bottom's going to be, but now is the time to start leveraging into these things with the expectation that, and hope, really, that 6 months from now you can buy it for half the price again.
Just on pure fundamentals, ignoring the inflation, people might say that, hey, well, silver's gone from $4 to 30 and gold's gone from 200 to 1600. Could this possibly be the top that we're seeing right now, and now it's going to come back down? Or is this not the end of the bull market?
Well, that's more of an economic call on what the gold price is going to do, and global currency debasement and printing money and all that sort of thing. Personally, I leave that to other people to figure out. I've got my own opinion.
Well, and I'm not an economist either. We're just dumb field geologists. But we are economic geologists, meaning we're very concerned with the economics of the business we're in. What I think is this is a pretty normal correction for precious metals and the main industrial metal that reflects short-term economy of the world, and that's copper. And copper's still range bound. Copper, I think, got as low as 350 this week, and now it's bounced a little bit again. But you look at copper, it's been range bound for the last 2 years almost, between $3.30 and $3.90. If you can't make money mining copper at $3.30, then get out of the copper business. You don't belong. You know, a company I cover that is will be a near-term producer, their pre-feasibility study indicates all-in costs $1.09 per pound of copper. That looks like a winner to me.
Yeah.
So it goes again to the lowest quartile of peer production, because high-cost production is going to come off and prices go up.
What are some questions people should be asking if they go to this resource show or another resource show, or maybe they find one on another newsletter? what are some questions people should look at when they look at, because there's so many mining companies?
Yeah, no, that's a good point. And I feel empathy for an investor walking into these shows whose business is running a store or something and just flooded with hundreds of junior companies showing them these maps where they're going to find this gold deposit. It's tough, so that's really good. In fact, on my website, one of the things that you can get for free, just contact me, is a list of questions to ask. But really what it comes down to now is how much money do they have, how far does that get them, and what does that get them? Just having $500,000 in the bank so you can live till next year, that's no reason to own a company. They need to be able to have enough budget to actually do some positive work, one. Two, on a project that's worth doing positive work on. I would say again, half the companies I look at, probably Mickey, they're working on a property that even if they're successful, it's irrelevant, it doesn't matter.
It's
so
not
you need to
going to make a mine.
Yeah.
Didn't have a chance from the get-go.
Exactly. And so much money is wasted that way.
Yeah.
So I guess those are the two things I would say, is look at the property, how much money they got, capital structure, and I guess the people.
Now, when you say it's not going to become a mine, you're saying that because it costs too much, or it's not feasible?
It's not. I have a saying, and I used to say this all the time. Dave Coffin and I, Dave's passed away now, but he was one of the geologists that was a newsletter writer. He actually didn't have a geology degree. Not very many people know that, but he's one of the smartest geologists I know. And we used to end our conversation all the time with, one of us would say, every good geologist knows that grade is king. So there's a lot more to it than grade, but you want to make sure that there's high enough grades, whatever they're drilling or whatever they're projecting in a resource estimate, a PEA, pre-feasibility study, whatever, is that the grades are high enough to support a profitable mining operation. I just looked at a company. The reason I was late to this interview by 5 minutes, I got promoted by a guy in there, and he's showing me his new IPO, and he's drilling grades of 0.4 grams of gold and half a gram of silver. I go, well, you need to increase the grade there, don't you? Yeah, but we think it's better at depth. Well, why would you think that?
Because it's not better here.
Yeah, because it's not better there. He's drilling under gravel. He's got a couple of drill holes with low grade. Now, well, you've hit an anomaly. And Brent, talk to us about anomalies. You're the anomaly guy.
What most of us exploration geologists do is go out looking for anomalies in the Earth's surface, be it geochemical, geophysical, whatever, and trying to find the very, very few instances where the geology, the chemistry, everything came together to form an economic deposit. But over the 4.6 billion years the Earth's been here, or 6,000 depending on who you are,
nice.
The Earth changes. That's what it does. It evolves. The ocean is subducted beneath the continent. It melts. It forms a volcano. The volcano cools. As it's cooling, it changes the rock around it from one to the other. That's an anomaly. It gets washed away. Another one comes. Over 20 million years, you've got hundreds of volcanoes that have come and gone and left their own special imprint. Each one of those is an anomaly, and each one of those is a potential site for a mineral deposit. But again, 1 in 1,000 might be a deposit. 1 in 10,000 is going to be something that's truly worthwhile. So that's what we're doing, is looking at geochemical anomalies. I don't think the general public understands that.
No, especially, I mean, you go into these shows, they've got these nice backgrounds, these nice flyers.
Everybody has
wow,
a story.
This is a great story. So-and-so's a part of it and a shareholder. I mean, in the end, it's what's in the ground, what kind of rocks you have. So people understand, in a mine, it does have a life. It's not like a normal business where, you know, a grocery store can be a grocery store forever at that corner location. It can be there for 100 years. These mines, you know, some of them have been mined a long time, I'm assuming, but average, what are these mines, you know, what at this current price of gold, how long can they mine some of these mines that they're finding?
On average, they try and mine as much as they can in 10 years for gold and maybe up to 20 for copper, but you want to get as much out as quickly as possible to jack up your NPV.
Yeah, because it's time value of money, right?
Yeah.
Because they're printing all these fiat currencies to begin with. So money today is worth much more than money is 5 years in the future, and that's where you get this net present value concept.
how important is the location? A lot of people want the United States, but is the United States really the ideal place to have a mine?
I'm not saying it's the ideal place, but it's certainly one good place. A lot of times it is about location. You know, it's a lot easier to develop a mine in the Basin Range sagebrush desert, what we call the quaternary stinking desert of Nevada, than it is in a cirque in the Yukon. We saw that recently. Big discovery made in the Yukon, a Carlin type discovery, and it looks like it can be high grade and immense, but it's on top of a cirque at 2,000 meters at what, 62 degrees north or something like that, and it's 100 kilometers from the nearest road, so location's important.
Yeah, well, they've got the advantage of, you know, Santa Claus stops there first.
Yeah. How long does it take to mine, like to go from discovery to production in the U.S. versus other countries?
That's a good question. On average, you can, you know, shortest time frame from discovery drill hole to production, you're lucky if you can do it 6 years. A lot of them take 10 up to 20. It really depends on so many factors that come in it. I mean, there's a deposit I worked on with Kennecott out of Salt Lake, the Skarn deposit, and they're still working on it. That's been 20 years now. They keep refining it and figuring it out. So it takes a lot of time. Then permitting issues and all that too.
Besides the permitting issues, I would dare say though that mine, it could be marginally economic. So and I don't know if this, are you referring to the molybdenum discovery under the pit, or?
No, the North Horseshoe, which is Skarn adjacent.
Right, okay.
Same kind of thing.
So if it was robustly economic, it would have been developed in a much shorter period of time. And we see this, what we've seen in this industry in this cycle, and it has a lot to do with the regulations that came out of the stock exchanges post-BRIACS, resource estimates. But what we've generally seen is recycling of old projects that, especially by juniors, that had something wrong with them. Either they were in difficult permitting districts, or they had infrastructure difficulties, or they didn't quite have enough grade, or they had some problems in metallurgy. So a lot of what we've been exploring the last 10 years, since 2003 when this boom started, are recycled projects that were sub-economic in the past. And some of those will be proven to be economic, but most of them still won't be developed because they're sub-economic. You can't make money at them.
Oh, that's not true. Those types of deposits have been recycled. That's sort of the perpetual annuity for the Vancouver stock mining scheme.
Well, yeah,
they keep bringing them back, raising money on them, but they're still the same.
I guess that in so many words, you put that very succinctly. That's what I was trying to say, and I was a bit long-winded about that. But yeah, so you're recycling old projects. You know, I know there's places in the world, Minnesota, the Duluth Gabbro, for instance. Those things were discovered in the mid-1950s. They were sub-economic then, and to my knowledge, they're still sub-economic today. There's not a mine in development in the Duluth Gabbro, and it's got copper, nickel, and significant platinum and palladium still haven't been developed. Galore Creek in the Yukon, or in northern BC, pardon me. It was discovered by helicopter in 1955. It was drilled out by Kennecott by 1965, and it sits there almost 50 years later still undeveloped because of infrastructure difficulties.
In closing, guys, as far as getting producers or exploration companies, is it too late to find an exploration company? Should you be looking at producers instead?
I would look at everything. I think it's good to have, like personally, I've got a spread from what I consider safe all the way down to high-risk exploration. Like just last week we bought a uranium company. It seems to be on to a discovery. So I think it's more the quality you're looking for. But make sure wherever you buy has got money to last, or something that's so good that they can raise money on.
You're still going to be able to raise money for the best projects. The institutions, the traditional institutional funding, I think, has gone away temporarily because basically people are redeeming shares and they've got to sell. So that portion of the business may not be around, but it's still, you know, there's a lot of money out there, and it hasn't got itchy. I remember at the end of 2008, 2008 and we're coming into 2009, we're seeing a lot of itchy money on the sidelines, really wanting to come into our business. It fueled the next leg of the boom. Right now that money is not itchy, but at some point there's still a lot of money on the sidelines. So as a geologist, we kind of have to be eternal optimists. So I prefer to end this on an optimistic note.
Thanks, gentlemen. Thanks for your time.
Thanks. It was
Appreciate
good.
it.